Hello friends, I'm Professor Nihit Jhaveri. I welcome you on behalf of JK Shah classes. Today we will be revising the chapter called Black Money Act BMA 2015. The correct name of this chapter is not Black Money Act. Black Money Act is a short form. Correct name of this chapter is a little lengthy. It is Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. In short, Black Money Act. Black Money Act was introduced by Modi government in the first year of Arun Jaitley ji. 26 May 2015 it was introduced. Financial year 15-16, AY 16-17, and it extends to the whole of India. Unlike equalization levy chapter, which was applicable to the whole of India except of Jammu Kashmir, this is applicable to each and every part of the country. Under this chapter, though it uses the term black money, the idea is to capture only undisclosed income and undisclosed assets outside India, located outside India. So two things are taxable under this act. Number one, undisclosed income, and secondly, undisclosed asset. But both of them outside India. If in India, then will be covered by Income Tax Act. If outside India, then only this act will be applicable. Undisclosed income from a source outside India, and for undisclosed asset, it should be located outside India. So for income, the source of income should be from outside India. If I earn income in India and transfer it abroad, then that cannot be called as undisclosed source from India, income from undisclosed source in India. It is from India. In order to be called as, or in order to apply this chapter, it should be undisclosed income from a source outside India, and for asset, it should be located outside India. Now, tax rate applicable here will be 30% flat rate. No surcharge, no health and education cess. This is not Income Tax Act, this is a separate act. Here there is no mention about surcharge and health and education cess. Plus there will be penalty at the rate of 300% of the tax under this act. So in case 100 crore rupees is found outside India, then tax will be 30 crore and plus 90 crore will be the penalty. Total 120 crore government will take away, plus imprisonment, plus other penalties. No basic exemption under this particular act like Income Tax Act, even if assessee is individual, HUF, AOP, BOI, come what may be. Okay, two things are taxable under this act, undisclosed income and undisclosed asset. However, as far as income is concerned, the amount of income will be taxable, but as far as asset is concerned, what is taxable is not the cost of acquisition. What is taxable is the value of the asset, value to be computed as per rule number 3 of black money imposition of tax law rules, which we will be discussing whatever is applicable. The title of this chapter as per institute's module is Overview of Black Money Act, meaning thereby entire chapter is not covered in detail, only overview, whatever are relevant points. And I really appreciate institute from the bottom of my heart. Whatever they have covered is absolutely to the point. I really appreciate institute from the bottom of my heart. Whatever they have covered is absolutely to the point. Okay, two more points with regards to undisclosed income and undisclosed asset located outside India. For income, amount of income will be taxable. For asset, value will be taxable. For income, income will have its own monetary value. If the income was 10 lakh rupees, then it is 10 lakh only. Value cannot change. There cannot be valuation done for a monetary thing. But as far as asset is concerned, outside India, undisclosed, then what will be taxable will be the value to be computed as per rule 3. In which year? Supposingly assessee earned income in financial year 18-19, AY 19-20. This year he earned income of say 2 crore rupees in terms of Indian rupees. This income is undisclosed. It is from a source outside India. It pertains to financial year 18-19. It was earned in 18-19. And on the other hand, assessee acquired asset worth 3 crore rupees, that is also located outside India, that was also acquired in 18-19. So what will be taxable? The answer for income, amount will be taxable, asset, value will be taxable, value is 3 crore. But in which year? So answer, both of them come to knowledge of AO in the current year, financial year 24-25. So the as per rule, income will be taxable in respective year to which it pertains. Income pertains to financial year 18-19, it will be taxable in 18-19. But as far as asset is concerned, asset will be chargeable to tax in that year in which asset comes to the notice of AO. asset will not be taxed in 18-19, asset will be chargeable to tax in financial year 24-25. Secondly, what will be taxable will be the value of the asset, which is to be computed as per valuation rule. For valuation rule, valuation date will be 1st April of that financial year in which the given asset comes to the notice of AO. It comes to notice of AO in financial year 24-25, then 1st April 24 will be the valuation date. We need to find out value as on that day. In case if the value is in foreign currency, which obviously will be in foreign currency, then we will have to convert it into Indian currency by applying some currency conversion rate. For all other chapters, we apply telegraphic transfer buying rate of State Bank of India. But for this chapter, we don't have to apply State Bank of India rate. We have to apply RBI reference rate. Remember, RBI reference rate for this chapter, and this is the only chapter where we apply RBI rate. Everywhere else, may it be capital gain chapter or special provisions for non-resident or rule 115 of income tax rules, everywhere we apply telegraphic transfer buying rate of State Bank of India. So as far as undisclosed income is concerned, it will be taxable in the year to which income pertains, namely financial year 18-19 in this example. But as far as asset is concerned, it will be taxable in the year in which undisclosed asset comes to the notice of AO, and not in the year in which it was acquired, or not in the year in which it was not disclosed. Okay, now basis of charge. Understand this chapter, as and when we proceed further, you will realize that this chapter is applicable only to a person who's ROR, resident and ordinary resident. This chapter does not apply to non-residents or a person who's RNOR. If you talk about individual HUF, and in case you talk about artificial persons like company, partnership firm, then chapter does not apply to non-resident, it applies only to residents. Why is it so? For a person, for example, my uncle is non-resident in India since past 40 years. My uncle has lot of assets outside India. Now, why would government of India want my uncle who's non-resident to disclose any asset in India? Naturally, so this concept applies for people like you and me, ROR, that we will discuss in upcoming point when we define the term assessee. So point to be noted out here is that under this chapter, what will be taxable will be amount of undisclosed income, amount or value of undisclosed asset. Both should be outside India, taxable at 30% rate plus 300% of tax as a penalty, taxable in that year in which it comes to notice of AO, and this chapter applies to ROR. These are the key points which we will be discussing. Some of them we are already done with. The first point is definition, meaning of certain terminologies used under basis of charge. Basis of charge title is irrelevant. Simply assessee definition. No need to remember section number, subsection, clause number. Assessee here would mean a person who's ROR. The question is, in which year should he be ROR? In our example, income was earned in financial year 18-19, which comes to notice of AO in financial year 24-25. Say asset is acquired. Let's talk about asset, and it comes to notice of AO in the current year. So assessee should be ROR either in that year in which asset was acquired, or he should be ROR in the year in which asset comes to notice of AO. Either of the year, and then action can be taken. Unlike Income Tax Act, here there is no upper time limit, there is no threshold limit. This act can cover a case of financial year 2000-2001 also, a 25-year-old case also, even if the asset was acquired in 2000-2001, or income was earned in 2000-2001 financial year, then also it can be covered up today if it was not disclosed at that time. As far as asset is concerned, asset is required to be disclosed every year in the IT return till the time assessee holds the asset. And in case if he is ROR, in case of income, income is required to be disclosed only once, the year in which income was earned. So in our example, income is acquired, income is earned in 18-19. So income is required to be disclosed in 18-19. Then assessee should be ROR in 18-19. Income should have also been earned in 18-19 and not disclosed in 18-19's IT return. Then it will be covered under this act. Any which ways, as and when we proceed further, you will come to know. When we say he should be ROR, which year should he be ROR? So with regards to asset, he should be ROR in the year of acquiring the asset, or he should be ROR in the year in which the asset is noticed by AO. So assessee means a person being resident in India as per section 6 of the Income Tax Act in the current previous year. Current previous year means the year in which asset comes to notice of AO, or or in the current year is non-resident or RNOR as per Income Tax Act in the current year, provided he was resident in India in the previous year to which income referred to in section 4 relates. In our example, income relates to financial year 18-19. In 18-19 he should have been resident, or he should have been resident in the previous year in which undisclosed asset located outside India was acquired. The year in which income is earned or the year in which asset is acquired, or in the current year, either of the year he should have been ROR, then section and the chapter will be applicable. As far as asset is concerned, it will be charged to tax in the previous year in which it comes to notice of AO. So for asset, it is clarified in the proviso form that even if it was acquired in 18-19 but it comes to knowledge of AO in 24-25, it will be taxable in 24-25. As far as income is concerned, earned in financial year 18-19, there is no clarification. Therefore, it is understood that income will be taxable in the respective year 18-19 in the absence of any clarification. Income of 18-19 cannot be charged to tax in financial year 24-25. Then section 3 read with rule 3 of black money rules says that as far as asset is concerned, value of undisclosed asset, not income, only asset, shall be determined as per rule 3 of black money undisclosed foreign income and assets imposition of tax rules 2015, simply black money rules. Okay, assets are divided into various categories. Rule 3 is applicable. Rule 3 sub rule 1 is divided into, it divides assets into various categories. Clause A, clause B, C, D, E, F, G, H. It divides assets into 8 categories. Out of these 8 clauses, only 2 or 3 clauses you will have to put in efforts to remember. Rest everywhere, most of the assets, the taxable value under Black Money Act will be either cost of acquisition or the FMV, fair market value, whichever is higher. Cost or FMV, whichever is higher. Only for 2-3 assets, we will have to work out the value with the help of some formula. It should be cost or FMV, whichever is higher. FMV as on what date? The answer, FMV as on the valuation date. And what do you mean by valuation date? Valuation date is clarified in rule 3 only, somewhere in the form of proviso. It will be, first of all, understand what we are supposed to value is only asset located outside India. Income is not to be valued. Valuation date will be 1st April of the financial year in which the asset comes to notice of AO. So in our example, financial year 24-25, 1st April 24. Okay, 30% is the rate. First 2 assets, first 2 clauses, rule 3, sub rule 1, clause A and clause B, the rule concept is same. 3 assets are covered by clause A and 5 or 6 assets are covered by clause B, 5 assets. Rules are same. Number 1, bullion, jewelry, precious stone. Bullion as in raw form of gold, silver, etc. Bullion as in, like if you talk about gold, then gold coin. Anything which is not given a shape of ornaments is called bullion. It could be round in shape, it could be oval, it could be square, it could be rectangle. It can be called as coin, guinea, biscuit, etc. That's bullion. Jewelry is something like gold ornaments which are given a shape of ornaments, jewelry. Precious stone, diamond, ruby, pearl, sapphire, emerald. Archaeological collection, now clause B. Drawing, painting, sculptures, work of art. For all the 7 assets, it will be higher of cost or FMV, whichever is higher. Whichever is higher. Okay, then clause C. Clause C, you will have to remember, clause C has got part 1 or item number 1, item number 2. Item number 1 is for quoted shares. Quoted means those shares or securities whose trading takes place regularly and there is a market price available. That is, they are quoted on a stock exchange. In India, we say recognized stock exchange, RSE. Here, we are talking about assets located outside India. So in India, the terminology used is recognized stock exchange. Outside India, it is established securities market. Established securities market. So for quoted shares and security, security would include bonds, debentures, etc. Again, it will be higher of cost or FMV, but FMV to be determined in a following manner. Fundamentally, it is cost or FMV, whichever is higher. FMV will be highest plus lowest price on the established securities market divided by 2. Highest price plus lowest price divided by 2. Average of highest and lowest price on any established securities market on the valuation date, and valuation date will be 1st April of the relevant financial year in which such asset comes to notice of AO. which is located outside India and which is undisclosed. Undisclosed means not disclosed in the IT return. There is no specific procedure to go and disclose this asset. The only way to disclose this asset is to disclose it in the IT return. If there is no trading on the valuation date, then point number B says go backwards. Say 1st April is the valuation date, but 1st April is, for example, Sunday. Go backwards, go to Saturday, 31st March 24. Find out highest plus lowest divided by 2 on 31st March 24. 31st March 24 also markets were not working. Go backwards, go to Friday, that is 30th March. 30th March also there was no trading. Go backwards, keep going backwards till the time you find the day on which they were last traded. Such asset or securities were last traded. Second point is unimportant. First point, simply average of highest plus lowest price versus cost of acquisition, whichever is higher. Clause 2, if it is unquoted shares. Unquoted and if it is equity shares. For unquoted shares and security, if it is unquoted equity share, then the valuation rules are slightly different, and if it is unquoted bonds, debentures, etc., then the rules are very straightforward. If it is quoted, then pick up the market price, but from market what is available is two price, highest plus lowest, so you find out average compared with cost. If it is unquoted equity share, then there is a formula, cost or FMV, whichever is higher. Everywhere it will be cost or FMV, whichever is higher, but FMV may have to be computed differently. FMV here will be based on formula A plus B minus L divided by PE multiplied by PV. This same concept was there in assessment of charitable trust chapter. Towards the end of charitable trust chapter, there was one concept of accreted income, tax on accreted income, which was also called as exit tax. There again, if a public charitable trust or religious trust is owning shares of some company and they are liable to be taxed under rule 17 CB as a part of accreted income, they are liable to be taxed under exit tax concept. Then we had to find out the FMV of such shares. For finding FMV, same formula was there, A plus B minus L divided by PE multiplied by PV. So basically PV divided by PE, this numerator and this denominator, what does it talk about? PV means the paid up value of those equity shares which are owned by the assessee. For example, assessee is Mr. X, he is ROR in India. He holds assets outside India. He holds shares of PQR Limited, which is the foreign company. PQR Limited foreign company, and they are which shares? Unquoted, unquoted equity shares, private limited company, that kind of a thing. Then PV is equal to paid up value of equity shares held by Mr. X. See, he holds shares worth 10 crore Indian rupees in terms of Indian rupees, and PE means the total value or total paid up equity capital of that company PQR Limited. So total paid up equity capital of PQR Limited is, for example, 200 crore. Then 10 crore divided by 200 crore, this will actually give us the percentage holding of Mr. X in that company. So this will give us 5%. 10 divided by 200 will be 5%. So in such situation, A plus B minus L will give us the net worth of the company PQR Limited. Net worth into 5%, meaning thereby if net worth of the company is 1000 crore, then out of 1000 crore, what is the share of Mr. X? Mr. X is a 5% equity shareholder, 5% owner. So out of 1000 crore net worth of that company, 5%, that is 50 crore will be the value of shares held by Mr. X in this company. Okay, where A plus B minus L, let's try to analyze this formula. Who is the assessee here? Mr. X is holding shares in which shares? Equity shares. Which type? Answer, unquoted equity shares of PQR Limited, which is 5% of the total shares of the company. A plus B minus L, so L we know pretty well. What is L? L is liability. A plus B, they are both assets. B means those assets for which we have to take FMV into consideration, and A means other than those assets which are covered by point B. Other assets we have to take book value. So assets covered by point A, we have to take book value, that is cost price or WDV. B means those assets for which we have to take FMV. So FMV is ideally to be taken for 8 assets or 7 assets, I would say: bullion, jewelry, drawings, paintings, archaeological collection, work of art, and shares and securities. Ideally these 8 assets we take FMV. and even immovable property. Barring this, all other assets, plant, machinery, etc., we take book value. Book value could mean either a WDV in case of depreciable asset or cost price in case of non-depreciable asset. Don't go so much deep into the matter, everything will be given in the question. This chapter is very easy. So B, let's start with B. B means FMV, FMV of bullion, jewelry, precious stone, artistic work, shares, securities, immovable property, which are determined as per manner provided in these rules. And A means those assets where you have to take book value. Book value could mean cost price or WDV. If it is non-depreciable, take cost price. If depreciable, then take WDV. Book value of all those assets other than bullion, jewelry, precious stone, artistic work, paintings, securities, shares and immovable property minus two assets will not be considered as assets. They are to be removed from the list of assets. Which two? Number one, income tax paid minus income tax refund claim. Income tax paid minus income tax refund claim. Okay, that is not your real asset. According to this, that should not be considered as asset because that is something reflecting amount payable to government. Secondly, amount shown as fictitious asset appearing in a balance sheet. It is appearing on asset side, but it is actually not a real asset. It's a fictitious assets, which is nothing but generally unamortized deferred expenditure. You can write down fictitious asset. Fictitious asset. Okay. And now L. L means liability. As far as liabilities are concerned, just like charitable trust chapter, here we have to take book value of liabilities and not the market value. But liability excluding 6. Following 6 items will not be regarded as liability. Very simple. First 3 are owner's capital like equity share capital, reserves and surplus, reserve for payment of dividend. And the last 3 are such liabilities which are actually not a real liability or not a third party liability. Let me explain it to you. First point, paid up equity share capital. Paid up equity share capital means owner's capital. Third one is reserves and surplus by whatever name called. Of course, other than depreciation reserve. So owner's capital, reserves and surplus and equity share capital are both owner's capital. Though appearing in on the liability side in the balance sheet, they are not actually amount payable to anybody. They are not liability to outsiders. They are not third party liability. Second one is amount set apart for payment of dividends on preference or equity shares. So first 3 are owner's capital. Dividend payable to preference shareholder is ultimately preference shareholders share of profit in the company. Okay, owner's capital. And the last 3, I would start with the fifth one, provision for any unascertained liability. Unascertained liability, next one is contingent liability. Contingent liability other than arrears of dividend in respect of cumulative preference shares. So arrears of a dividend, barring that, other contingent liability. Normally contingent liabilities do not appear in the books of accounts or in the balance sheet. They appear always as a footnote. But in case if it is shown in the books of accounts, then it is to be removed from the liability category. And any unascertained liability, we had discussed this concept in MAT chapter also, minimum alternate tax. We had discussed it in somewhere in transfer pricing chapter also. Briefly, we had discussed it mainly in charitable trust chapter. And similar point you must have studied at inter CA in income from other sources also. Okay, doesn't matter. Idea is that these two are not your real liability, remove them. And then fourth point, which is amount of provision for taxation. This is nothing but provision for taxation as in deferred tax liability, DTL, deferred tax liability, which is nothing but income tax paid minus income tax refund claim in excess of tax payable on book profit, in excess of tax payable on book profit as per law. Book profit as per any law as in profit as per company's books of accounts. Any which ways, this is unimportant. These 3 are not a real liability. Therefore, you don't consider them. And first 3 are owner's capital. They are not payable to outsiders. So while computing net worth of the company, PQR Limited, foreign company, in which X is invested, these items to be removed. Institute may ask you a question in exam, but in real life, finding out of all these things is next to impossible, very difficult. Okay, I have a couple of clients who have invested outside India, but it's not possible to get all these details from company, foreign company, unless you are a major shareholder. But in exam, everything would be readily given to you. You just have to remember formula. Okay, what are we discussing? So clause A, rule 3, sub rule 1, clause A is for jewelry, bullion and precious stone. Clause B, artistic work or drawings, paintings, archaeological collection, etc. Both of them, cost or FMV, whichever is higher. C point is unquoted securities, unquoted shares and securities. Then you apply this formula, A plus B minus L into PV divided by P. Clause 1 is quoted shares and securities. Clause 2, or rather subclause 2, is unquoted, but here for unquoted we have two categories, unquoted equity shares, and then item number 3 will be unquoted other securities other than equity shares. So if you can understand, shares and securities are to be valued under 3 items of clause C. So now, and PV and PE, PE is equal to total amount of paid up equity share capital as shown in the balance sheet. Whose paid up equity capital? Of the company as a whole. And as far as PV is concerned, paid up value of such equity shares. Such equity shares means those which we are valuing currently, owned by Mr. X, 5%. So PV divided by PE will practically give you what is the percentage holding of Mr. X in this company, and A plus B minus L will give you net worth of this foreign company, for which we need further data. And clause C, item number 3, for unquoted other than equity share, unquoted share securities other than equity share. Here is very straightforward, either cost price or FMV, whichever is higher. Simple. Clause D, immovable property. This is slightly important. Here also same, cost or FMV, whichever is higher. Practically in the whole chapter, in all the valuation rules, fundamentally it is cost or FMV, whichever is higher. Only if it is unquoted equity shares, then FMV to be found out by applying this formula, A plus B minus L into PV divided by PE. Okay, so you will have to remember unquoted equity shares, that is because formula base, that is important. Clause C, item number 2, and clause D is also important, but very straightforward, immovable property. Clause E, bank account. Bank account is slightly complicated. For bank account, logically speaking, you would feel bank account outside India, you would feel what should be taxable will be bank balance. Bank balance as on particular date. That is valuation date 1st April 24, but that's not the correct answer, because assessee may manipulate. Every year 1st April he will see to it that bank balance drops down to 0 level. Next day again he will redeposit. Next 31st March again assessee will withdraw, and then 2nd April he will deposit. So whenever he is caught, whenever bank account comes to knowledge of AO, as on valuation date bank balance could be 0. So what is taxable is not bank balance. What is taxable for bank balance as a value of bank balance or value of bank account will be equal to total amount deposited till now. Sums of all the deposits made in the bank account since the date of opening it. So in case you have deposited 36 crore rupees till now, entire 30, your bank balance may be 5 lakh rupees equivalent in foreign currency. Bank balance may be 5 lakh rupees, but total amount deposited by you up till now is 37 crore rupees. 37 crore will be the value of bank account. This could be very killing. However, when this act was introduced in July 2025, July 2015, at that time government had kept some amnesty scheme under section 59 of this particular chapter, chapter 6, section 59, amnesty scheme, which is not to be studied now any further because the scheme was already over. In case bank account was already disclosed, what is the value of bank account? Value of bank account will be total amount deposited till now, from the date of opening till 1st April valuation date. However, if the bank account was disclosed in that amnesty scheme in July 2015, then the value of bank account will be whatever amount is now deposited after the making disclosure of bank account under this particular act. Under this act, in case the assessee opted for amnesty scheme and he made true and full disclosure of all assets outside India, then the tax rate would have been 30%, penalty would have been 100%. As of now, tax rate is 30%. Amnesty scheme is already over, there in July 2015 only. But in case if somebody opted for it, he had to pay 30% of the value as tax plus 100% of tax as a penalty. Now if he discloses after amnesty scheme is over, then 30% as a tax and 300% as penalty, huge amount will be payable. Okay. So second point, it says such bank account was already declared under section 59 and the value of such bank account is already assessed to tax, already charged to tax and penalty under this act. Then the value would mean all deposits made from the date of such declaration. Once you declared it on, let's say 18 July 2015, then any deposit made after 18 July 2015 will be considered the value of bank account. This is something very unusual for bank account. So remember, total amount deposited in the bank account outside India will be considered as a value. However, there is a proviso to this rule 3 subrule 1 clause E, saying that if any amount deposited in the bank account was out of withdrawal from bank account, was out of withdrawal from the same bank account, then should not be taxed again. So total amount deposited by me in the bank account till today was 10 lakh. I withdrew some 3 lakh rupees for emergency purpose and now I did not require it, so I redeposited bank in the bank account. So in my bank account 3 lakh got reduced when I withdrew and again I redeposited back, 3 lakh is recouped back, bank balance becomes intact, bank balance comes back to its original level 10 lakh. But as far as value of bank account is concerned, which started with 10 lakh, whatever is deposited will be added, value of bank account will become 13 lakh, amount withdrawn was not supposed to be subtracted, whatever is deposited till now, pure deposit, that was considered as a value of the bank account. Accordingly, in spite of having 10 lakh bank balance earlier and again having 10 lakh bank balance, what will be considered the value of bank account under Black Money Act would be 13 lakhs. So however, any deposit made from the proceeds of withdrawal from that bank account shall not be taken into while computing value of bank account, otherwise it will amount to double valuation or double taxation. Okay, then clause number F and G and then clause H. Clause F and G is bit off the track. Clause F and G are applicable in case if assessee Mr. X, who is ROR in India but is a partner in a partnership firm outside India or is a partner in an LLP. As far as he being a shareholder was concerned, unquoted shares, then we applied this formula. If I am a shareholder in any company, then I will have only one type of share, that is what is my percentage shareholding in that total shares of that company. There can be only one ratio, but if I am a partner in a partnership firm, there could be two types of ratio. I may have a different capital contribution ratio in that firm and I may have a different profit sharing, loss sharing ratio or dissolution ratio, meaning thereby a person may be 30% partner in a firm based on his capital contributed, but based on his profit sharing he may be 50% partner. So for partnership firm there is a combination of two ratios. If you ask me, sir, what percentage you are a partner in ABC and company, then I will tell you from what angle are you asking. From capital contribution point of view, I have contributed 30% of capital. Profit sharing ratio wise, I am entitled to 50% of the total profits. So whether to call me as a 50% partner or 30% partner, so government says let's have a combination of both. So clause F and G of rule 3.1, value of an interest of a person in the partnership firm LLP, AOP, BOI in which he is a partner or a member. What to do here? Step by step. First of all, you apply that formula A plus B minus L, that's it, that will give you net worth. In whose hands should you apply this formula? Apply this formula in the hands of AOP, LLP, BOI firm. Apply this formula in the hands of these people. Find out how much is the net worth of the firm. Here don't do PV divided by PE, that is not to be done. That is to be done only in case of company. To find out of 200 crore shares worth of shares of the company, what amount of shares are held by Mr. X. So he is holding 5% shares. Just to find out that 5%, we did this PV divided by PE, but here we will not do it this way. Whatever net worth you found out for company, in that case foreign company, same way here you find out the net worth of the firm AOP, LLP, etc. This is net worth of the firm. Now what you do? There are three partners A, B and C. So now whatever is the net worth of the firm that you apportion, say net worth is 1800 lakh. 1800 lakh to be apportioned amongst three partners A, B and C. But in what ratio? So let's understand. Here, unlike company, unlike shareholding in a company where there is only one ratio possible, 5% out of total 100%. Under partnership form, unlike company, here there are 2 ratios available. That's why we are facing this difficulty. Suppose any ABC LLP is a assessee. ABC LLP is located outside India. 3 partners A, B and C. Out of these 3 partners, whosoever is ROR in India, he should have made a disclosure in the IT return that I am partner to the tune of so much and my capital contribution is this much. Say profit sharing ratio is 2:1:3. How much capital these people have contributed? 300 lakh, 100 lakh, 200 lakh, totaling to 600 lakh. Now you find out net worth of the firm. Net worth say turns out to be 1800 lakh, 18 crore. On this 1800 lakh, what you do is that you split it into 2 parts. Find out of 1800 lakh, how much is equal to capital contributed by all partners. How much is equal to capital contributed by all partners? Capital contributed by partners is 600 lakh. So split this 1800 lakh into 2 parts. 600 lakhs, that much which is equal to capital contributed by partners. How much capital or which capital account? Answer: capital account, current account, both. And capital account balance standing as on the valuation date, as on 1st April of the relevant previous year. And then balance assets. So capital to the tune of 600 lakhs, you split amongst 3 partners ABC in the ratio of capital contribution, and balance 1200 lakhs you split in the ratio of profit sharing or dissolution ratio, as the case may be. I will tell you which ratio to be applied, but primarily first you apply this formula. Step number 1, apply formula in the hands of firm, that will give you net worth of the firm. Step number 2, net worth you divide into 2 parts. How much is equal to capital contributed by all partners and balance, and that much part which is equal to capital contributed by all the partners, original capital contribution, that will be divided amongst them in the ratio of capital contribution, and balance 1200 lakh will be divided amongst the 3 or apportion amongst the 3 in that profit sharing ratio or dissolution ratio. So let's try to understand. This 600 lakh will be apportioned in what ratio? Their capital contribution ratio is 3:1:2. This one 3:1:2. So 600 lakh divided in 3:1:2 ratio. 3:1:2 ratio, it will be 300 lakh, 100 lakh and 200 lakh. Now the story with 1200 lakh, the balance amount, balance to be apportioned in the ratio of profit sharing. Profit sharing ratio is how much? 2:1:3 given. So 2:1:3, here it will be 400 lakhs to A, 200 lakhs to B and remaining 600 lakhs to partner C. Having done this, so what did we do? Step number 1, find out the net worth of the firm AOP BOI LLP. How? By applying formula A plus B minus L, that formula. Then find out the net worth, that is 1800 lakh. 1800 lakh divided into 2 parts. How much is equal to capital contributed by all partners, and second part will be balance 600 plus 1200, and as much as is equal to capital contributed by all partners, split it amongst them in the ratio of capital contribution as on valuation date 1st April. And for remaining 1200 lakh, apportion amongst the partners in the dissolution ratio. This is to be done ideally in dissolution ratio. I will tell you why we kept it pending. Dissolution ratio. However, most of the firms don't have a dissolution ratio. In case there is no dissolution ratio or there is no agreed ratio, if this is not there, then second priority to be given to profit sharing ratio. Dissolution ratio will be given first priority, PSR will be second priority, meaning thereby both are available, then priority will be given to dissolution ratio. Real life, nobody has dissolution ratio included in a partnership deed, because at the time of instituting the partnership firm, creating, people don't know in what ratio they will distribute. They will not think negative about anything. Okay. Now what you do is that, now you take the total partner wise. For each partner, take the total. Partner A deserves 300 lakh from part A and 400 lakh from part B. Total amount for partner A will be 700 lakh. Same way, partner B 100 lakh from here and 200 lakh from here. Total is 300 lakh for partner B. And for partner C, it will be 200 lakh from here and 600 lakh from here. Partner C, it will be 800 lakhs. 700, 300 to B and 800 to C. I hope you have understood this. Partner A 300 plus this 400, total 700. Partner B 100 plus this 200, 300, and partner C, that is 200 lakh plus 600 lakh, total 800 lakh. Complicated? Answer, but this is unimportant. If you understood well, it's very simple, very straightforward. Right? This is how it is given in your notes. So, in the event of dissolution, apply dissolution ratio, but if there is no such agreed dissolution ratio, they have not inserted in the partnership deed that whenever they dissolve, they will distribute assets in this ratio, then by default take PSR, profit sharing ratio, and the net assets of firm AOP LLP will be A plus B minus L, whatever we discuss for company. Are you clear? Okay. Any other asset other than the above, last clause, clause H, any other asset, whatever you can think of, cost or FMV, whichever is higher, which is the standard practice. Okay. Now, rule 3, sub rule 2 and sub rule 3, interesting. It says, this is quite interesting and important also. It says, if the asset was acquired in financial year 18-19 and it comes to knowledge of AO today, asset was acquired in financial year 18-19 outside India and it is undisclosed. It is outside India, it is undisclosed. However, comes to notice of AO, comes to AO's notice in financial year 24-25. Then what to do? Then it will be taxable in 24-25, right? Okay. However, asset was acquired in 18-19, but now this asset is sold off. If I bring a twist in the story, if I tell you that asset was acquired in 18-19, comes to notice of AO in current year, so with the valuation date will be 1st April 2024, that is okay. But what if the asset is sold off? If it is still there, asset is still there, then you take cost or FMV, whichever is higher. If still there as on 1st April 24, Assessee still holds it. Assessee has sold it off, then the value will be equal to cost or selling price, sale price, whichever is higher. Whichever is higher. Simply asset sold off before valuation date, then cost or sale price, whichever is higher. And if asset is still there as on 1st April 24, then cost or FMV, whichever is higher. Instead of FMV, asset is sold off, then you replace it by sale price. Okay, this is done. Now this is rule 3, sub rule 2. Value of an asset other than bank account which is transferred before the valuation date. It says shall be higher of the following two: higher of cost of acquisition and sale price. Normally we take higher of cost or FMV, here will be cost or selling price. However, if asset was transferred for inadequate consideration or without consideration or for inadequate consideration, then what to do? Cost price is 10 lakh rupees, cost 10 lakh, FMV as on the valuation date would have been 80 lakhs if assessee would have continued holding the asset, but it's sold for 12 lakhs. Then what do we normally do? If the asset is still lying with the assessee, then cost or FMV, whichever is higher, and accordingly we would take 80 lakhs. However, asset is sold off, then we take sale price, let's say sold for 12 lakh, or the cost of acquisition 10 lakh, whichever is higher, 12 becomes higher. Government knows all these tactics. So what government has done, they made the rule that if sold for inadequate consideration or without consideration, then the value of such asset shall be higher of cost or FMV, whichever is higher. Instead of cost or, if asset is sold off, then you have to take cost or selling price. But instead of selling price, you replace it by FMV if sold for less than market value, inadequate consideration or without consideration. Rule 3.3, very important. It says, understand, my income, undisclosed income outside India is 50 lakh rupees. From 50 lakh, I acquired some asset. Asset is acquired for, let's say, 60 lakhs. Both of them were not disclosed. This was a story of AY 1920, financial year 18-19. Financial year 18-19, somebody acquired asset, somebody has income, 50 lakh income, and then same from that income 60 lakh worth of asset is acquired. So tell me how much I have earned. Supposingly I am the assessee ROR and I have this undisclosed income from a source outside India. Undisclosed income is 50 lakh rupees. I am not commenting on my Indian income. Indian income is taxable otherwise also. I am talking about my income from a source outside India. If, okay, so ideally what should be taxable? So income is taxable in 1819 plus value of this asset, let's say asset value is 60, total 110 would be taxable, which is unfair. So government has made this rule 3.3 saying that whatever is invested in the new asset, if anything is invested in the new asset, then whatever amount is utilized to acquire that asset shall be reduced from the taxable value. Asset number 1 is sold. Asset 1 is sold. Cost of acquisition 12 lakh rupees. Market value 20 lakh rupees and it is sold for 24 lakh. Asset is not present as on the valuation date. What do you do? Asset sold off before valuation date. Then you take cost or selling price, whichever is higher, 24 lakh. Not sold, not yet sold. Cost of acquisition is same, 12 lakh rupees. FMV is 20 lakh rupees. Not sold, so selling price is not available. Then what to do? Then cost or FMV, whichever is higher, 20 lakh is the value. So for the same asset, if not sold yet, value 20 lakh, market value, and if sold off, then market value or selling price, whichever is higher. So value of an asset acquired out of consideration, which is received on transfer of old asset or out of withdrawal from bank account. An assessee is buying, say, let's say a building is going for redevelopment. Let's say if one asset is sold and another asset is acquired. One asset acquired for particular amount, sold, sale proceeds are deposited in bank account, and utilizing bank balance, another asset is acquired. In such a case, the value of old asset or the value of bank account determined as per earlier rule shall be reduced by the amount of consideration invested in the new asset. What does this mean? I have covered example here only, and here also I have covered. Say house 1 located in country outside India was bought in 2000 year for 16 lakh. 16 is the cost of acquisition. Sold in 2005 for 22 lakhs. So after selling for 22 lakh, it must have been deposited, 22 lakh must have been deposited in the bank account. And the moment you deposit in bank account, your bank balance will increase. The asset, though it is already sold in 2005, then also its value will be taken into account. Taxable value will be cost or selling price, whichever is higher, unless sold at less than market price. Cost is 16 lakhs. Selling price, it is already sold off. Market value was 22 lakh, but it was sold for 18 lakhs. Then what to do? Whichever is higher, this becomes the taxable value. Now in case if this amount is deposited in bank account, let's say it's sold for 22 lakh, 22 would be deposited in bank, and from bank account you are buying another property by spending or by withdrawing from bank account. Amount was deposited in a bank account in that country. In the year 2010, that is after 5 years furthermore, house number 2 was purchased for 35 lakhs. Investment in house number 2 was made through withdrawal from bank account and in the foreign country, and house number 2 has not been transferred before the valuation date. Its value on the valuation date is 52. 3 assets are there. Old asset, house number 1, which is sold off. Then bank account where money deposited, that's a second asset, and third asset is house number 2 newly acquired. We will have to find out the value of all 3 of them, assuming that the value of foreign bank account as computed under rule 31C is 60 lakh. Bank balance or value of bank account is 60. Remember one thing, let me remind you again, bank balance is different and value of bank account is different. Bank balance means whatever is lying in your bank account, and value of bank account would mean amount deposited till now. Okay, in this situation, how much will be the value? Which is the first asset? House 1, but it is sold off. Value will be actual cost of acquisition 16 lakh or selling price 22 lakh. So house number 1 is done, value will be 22 lakh. Value will be 22 lakh. However, if anything deposited in the next account or any amount out of 22 lakh is utilized to acquire new asset, will be reduced from the value of this 22. So it says entire amount of 22 was deposited in bank account. The moment you deposit, remove it from value of this asset, taxable value comes down to 0. Taxable value of house number 1 becomes 0, but bank balance has increased now. Bank balance has increased, sold for 22 lakh, bank balance will shoot up by 22. Now if bank account is not disclosed outside India bank account is not disclosed in IT return in India, then assessee will be caught. Whenever caught, he will be subjected to tax. At that time, this amount 22 asset does not appear, but there is a value of this asset 22 lakh offered to be offered to tax. However, if amount was deposited in bank account in that country, then what will happen? Sale proceeds are deposited in bank account. Value of bank account shoots up by 22 lakh. Value of old asset will reduce by 22 lakh. 22 lakh will be added to the bank account because deposited, and same amount should be reduced from the value in the hands of assessee. Okay, so one by one, assuming that foreign bank account value is 60 lakh, house 1, what will happen? Sold for 22, the higher of 16 cost of acquisition and 22 selling price, 22 minus 22. Why 22 minus 22? Gain should be 22. Agreed. But out of 22, whatever is deposited in bank account, next asset, that much should be reduced from the previous asset. Normally, human psychology, we tend to go backwards to find out the audit trail. I receive 100 from you, so in your hand it should be exempt. Or in your hand, simply we go backwards. We find with the last person. Here we'll go with the last asset. Last asset is house number 2, whose value is house number 2. It is acquired for 35 lakhs. House 1 located in country outside India was bought in the year 2000. This is the same example which we read from here. So what is to be done now? House number 2 value is 35 lakh or 52 lakh, whichever is higher, 52. Now we will go backwards. This will remain 52, confirm. Whatever is invested in this asset, if it is invested from bank account, then go backwards, reduce this 35 lakh cost of acquisition of latest asset, reduce it from the value of preceding asset using which this was acquired. So preceding asset was bank account, foreign bank account is 60 lakh, value is readily given to you, minus 35 lakh invested in house 2, reduce it. The value of bank balance or bank account will come down to 25 lakh, and whatever is deposited in bank 22 lakh shall be reduced from the value of preceding asset. Value was 22, 22 minus 22 is equal to 0. Rule 3, sub rule 4 and 5. What will be the valuation date? So let's first finish the next point. Explanation 2 and 3, relevant date. So it says valuation date would be 1st April of the previous year. That's very simple, we already discussed. Rule 3, sub rule 4 and sub rule 5, this also partly we are done with. It says RBI reference rate to be taken into account. If the asset outside India is in the form of foreign currency, then what you do? Convert it into Indian currency. Provided step number 1, direct conversion. Direct conversion is possible from foreign currency to Indian currency, possible only if the value of foreign currency or value of asset in foreign currency was, or it is that foreign currency which is one of the 6 permitted designated currency as per RBI. RBI, out of total world currency, RBI has designated 6 currency which are called as permitted currency. In India, if you want to do forward market trading, you are allowed to do it only in 6 currency: US dollar, euro, Japanese yen, Italian liga, and there are 2 more currencies I forgot right now. Direct conversion means in case of the value of foreign asset is in terms of dollar, let's say it is $1,50,000 US dollar, then straight away from dollar convert it into Indian rupees. However, indirect conversion means that situation where the value is available in foreign currency, such a foreign currency which is not one of the permitted currency as per RBI guidance note under FEMA. So the value of that given asset is 30 lakh Turkish lira. Turkish lira is not one of the permitted currency or not one of the designated currency by RBI. So you can't convert it into Indian rupees directly. 30 lakh Turkish lira, convert them into US dollar. Whatever is the answer, from US dollar convert it into INR. Value of an asset determined in foreign currency. Such a foreign currency which is one of the permitted currencies designated by RBI under FEMA, converted into Indian currency applying the reference rate of RBI as on the valuation date. However, in case if it is not in a permitted currency, then value of the asset is determined in such a foreign currency, let's say Turkish lira, which is not one of the permitted currency designated by RBI. Then indirect conversion, what you do, 2 steps you will have to follow. Here directly convert from dollar to rupees. Under indirect valuation or conversion, 30 lakh Italian lira, convert them into US dollar, and whatever is the answer in US dollar, convert it into Indian rupees. For converting from dollar to Indian rupees, you will take forex rate of RBI. Rate published by RBI will be taken into account. And as far as converting lira into US dollar is concerned, it will be conversion rate shall be or exchange rate shall be as per rate of exchange of the central bank. The way we have RBI, which is central bank in India, same way that foreign country will also be having some bank. Exchange rate will be from conversion from lira to US dollar, exchange rate shall be of central bank of that foreign country. Such value shall then be first converted into US dollar as on valuation date as per rate specified by central bank of that country in which asset is located. Such value in US dollar shall be converted into Indian rupees applying telegraphic transfer buying rate? No, applying RBI reference rate as on valuation date. Okay. Now, explanation 2 is done. Valuation date will be 1st April of the relevant previous year, not assessment year. Now, this is the next concept, section 4, scope of total undisclosed income and asset. Title looks very nice, scope of total undisclosed income. Scope means you will come to know how much will be taxable. Answer, nothing is properly clarified. It's just that government has given a wrong title or misleading title. Simply it says, while computing undisclosed income from a source outside India, if any disclosures were already made in India, that much to be ignored. Whatever is already disclosed in India, that much will be ignored. It says, while computing undisclosed income of amount of undisclosed income, the undisclosed foreign income and asset would be income from a source located outside India which has not been disclosed in IT return, or income from a foreign source located outside India in respect of which IT return is required but no IT return, belated return has been filed. First point. Second point, what is the difference? Difference is that first point applies to a case which is prior to financial year 15-16, prior to the year in which asset was acquired and you had already disclosed it. Income was already disclosed. From that income you acquiring asset, then it's okay. They will not charge you tax. If it is not disclosed in the IT return, then they will charge you, which is possible only when IT return was filed. Suppose any IT return not filed, then second situation, income from a source outside India in respect of which IT return was required but no IT return, belated return has been filed, then that will be undisclosed income. Because where else can you disclose? There is no disclosure possible anywhere else. Out of compulsion you have to disclose here. And last, value of any undisclosed asset. I would say this is not to be done. This is important. Last point, no double taxation means particular asset is included under this act, it would not form part of total income under Income Tax Act, otherwise there will be double taxation. Now computation of undisclosed foreign income and asset. So this is divided into two parts, section 5 clause A and section 5 clause B, both are important. 5 clause A says which all things will not be allowed to be deducted. 5 clause B says which all things will be allowed to be deducted from the value of foreign asset. Say disallowance of expenditure and set off of loss. Once you read the title, you will automatically understand what are the contents. No need to study also. No deduction will be allowed for any expenditure incurred or allowances or set off of any loss while computing income under this act, even if such expenditure is allowable under Income Tax Act. And permissible deductions from undisclosed asset, this is very important. Permissible deduction. Suppose I earned foreign income 80 lakhs is earned. Then I acquired asset outside India. Assets to be valued. Suppose any value of asset is 100 lakh. This 100 lakh worth of asset is acquired out of this 80 lakh rupees. Foreign income of the assessee in India. Then 80 lakhs is taxable in the financial year 18-19, the year in which it was earned. Suppose any assessee did make a disclosure that time. So 80 lakh must have already been taxed. Now using such net of tax income, I am buying an asset for 100 lakh which includes 80 lakhs. 20 lakh balance is of some other family member. 100 lakhs, this is. Say withdrawn from bank account. Asset is acquired for 100 lakh rupees, that is cost of acquisition. So what to do now? The answer doesn't matter. This has already been taxed, income already taxed in 18-19. Asset comes to notice of AO in financial year 24-25. In 24-25, AO will charge 30% tax on the value. Value is 100 lakhs. That's a cost recently acquired. And that 100 already includes this 80 lakh on which tax already paid. Actually, by shifting from income to asset, assessee ended up putting extra 20 lakh. 80 lakh is coming from here, from income. 20 lakh is the extra value addition. So no need to worry. Rule 3, sub rule 2 says that reduce it. Under rule 3, reduce. How much? 80 lakh. Whatever is the cost of acquisition of previous asset invested in the new asset, 20 lakh will be taxable. Two things are allowed to be deducted. Number 1, income which has already been taxed or assessed to tax under Income Tax Act for any assessment year prior to the AY to which this act applies. Meaning whereby income which is already assessed to tax, reduce it, as in this one. Income which is already assessed to tax prior to introduction of this act must have been assessed to tax under Income Tax Act. So assessed already under Income Tax Act up to AY 14-15, that much will be allowed to be deducted. Second point, income which is assessable or has been assessed to tax under this act or for any assessment year. This is basically to avoid double taxation. Income which is assessable or already assessed under some other category. However, assessee will have to prove that 80 lakh rupees were invested in acquiring this asset. Assessee cannot prove, then taxable value will be 100 lakhs. 100 lakh is the value. Out of that, 80 lakh already disclosed in the name of income, 20 lakh should be taxed. If assessee cannot prove this, this will not be allowed. Assessee will be taxed on 100 lakh value of fixed asset or asset located outside India. Okay, clause C, very important, permissible deductions. What are the deductions permissible? So what were we discussing? Answer, permissible deduction only. Now this was general point, clause B. General point. Clause C is what all the permissible deductions from immovable property. If the asset is immovable property, answer then also same only, na? Answer yes, same but slightly different. What is it? Immovable property, say undisclosed income say financial year 18-19, total income was 200 lakh. Out of that, how much was disclosed, how much was not disclosed? Assessee that year had taken a chance, he had disclosed 80% of 200 lakh, that is 160 he had disclosed. Balance amount was undisclosed. Undisclosed means where IT return 20% amounting to 40 lakh rupees. Now using this 200 lakh before being caught, he acquired asset, acquired a capital asset which is immovable property. If it is immovable, bracketed wordings I am removing. Let me tell you in general first. Now what to do? So as per rule 5, as per rule 3, sub rule 5, it says asset acquired, second asset is acquired, find out the value. Value turns out to be cost of acquisition, also I will write. Cost of acquisition is 200 lakh. Income earned straight away, property acquired. Right now FMV is, let's say, 300 lakhs. Therefore taxable value will be higher of these two, taxable value will be 300 lakhs. From 300 lakhs you should be getting deduction of whatever income is utilized to acquire such asset. How much income was disclosed? 160. So technically, if this asset is movable asset, movable property, then the value is 300 lakh. From 300 lakh subtract 160. 140 will be taxable. But if it is immovable property, then what to do? For immovable property, value is same, 300 lakh, but now what you deduct is something proportionately. What proportion? So what proportion of income was disclosed? 80%. 80%. So now what you do is that 80% of the value shall be reduced. Reduce 80% of 300 lakh. Earlier what was to be done? Whatever was disclosed, that was straight away to be subtracted. 160 were to be subtracted. Same thing we do today also for other than immovable property. For movable assets, we will subtract whatever income was disclosed. And for asset, we will apply percentage 240 lakhs, that is 80% of 300 lakh. Only 60 lakhs will be taxable. Same situation, if it is movable property, 140 taxable. If it is immovable property, only 60 taxable. Then I have given some illustration, you can have a look at it. Quantum of deduction would be the amount which bears to the taxable value, that is 300 lakh, the same proportion as the assessed or assessable income bears to the total cost of the asset. Okay. So in the first illustration, plot of land, exactly same illustration which I just taught you. Okay, but let's read it. Plot of land, that is immovable property, outside India was acquired by Mr. X in financial year 15-16 for 50 lakh. Out of that 40 lakh, that is 80%, was already assessed to tax in the total income of 15-16. How much has already been taxed? 40 lakhs, 80%. How much is not taxed? 20%, that is 10 lakhs. In 24-25, such immovable property comes to knowledge of AO. FMV of this immovable property on 1st April 14 is either 70 lakhs or 100 lakhs or 200 lakhs. 70 lakh, 100 lakhs, 200 lakhs, 3 options. What to do? How much is disclosed? 80% is disclosed. Simply, whatever is the value, reduce 80% out of that. 80% of 70 will be 56 lakhs, 7 8s are 56, taxable value will be 14 lakh. If 100 lakh is the cost of the asset or FMV of the immovable property, the taxable value, then out of 100, 80 is already disclosed, 80% is disclosed, 20% will be taxable. If the FMV of this property is 200 lakhs, then I will get deduction of 160 lakh from 200, taxable value will be 40. Clear? Now the next is penalties. Penalties, there are 5 penalties ranging between section 41 to section 45. Which 5 penalties we'll be discussing? So section 41 to 45 are 5 penalties. Section 46 is issue of show cause notice for levying penalty, and section 47 is penalty order, or rather I would say time limit to pass penalty order, time limit. So let's understand one by one. 5 penalties in all. Very first is section 41. Section 41 is the most important penalty, the primary penalty, which is 300% of the tax under this particular act. In a case where tax has been computed in relation to undisclosed foreign income and asset, simply whenever assessee is taxed under this particular act, this 300% penalty is short leviable. Next 2 are failure to file IT return. So the person who is ROR in India and he earned some income outside India from a source outside India, he was supposed to file IT return in India and he was supposed to make a disclosure. If he does not file IT return, then 10 lakh rupee penalty, and in case he files IT return but does not furnish the information in the IT return, then also 10 lakh penalty. If he does not, let's read this properly in detail. Failure to file IT return, simply remember failure to file IT return or failure to furnish information in the IT return, both of them, of course both of them cannot coexist together. Either IT return is not filed, then section 42, IT return is filed but disclosure is not made, then for section 43. IT return not filed as required under section 139(1) of the Act before the end of the relevant assessment year by a person who is ROR and is holding asset including financial interest in any entity located outside India as a beneficial owner or as a beneficiary, or is having income from a source located outside India. Either he is having asset outside India as a beneficial or beneficiary including interest in any financial entity, or he is earning or he has income from a source outside India, then he was supposed to file IT return, does not file 10 lakh penalty, files but does not disclose the information about his asset and income, or he furnishes inaccurate information, for the person being ROR, 10 lakh rupees. Section 44, if he does not pay the tax which is 30% of value of the asset or 30% of amount of undisclosed foreign income, then payment of tax in arrear penalty will be equal to tax in arrear. And section 45, which is similar to 272A subsection 2 of Income Tax Act. In Income Tax Act it was 10,000 flat penalty. Without reason, assessee fails to answer any question put to him, or after answering the question he fails to sign any statement made by him which a tax authority may require, or fails to attend or produce books of accounts documents in response to summons, then penalty here will be minimum 50,000, maximum 2 lakh rupees. Under Income Tax Act, same penalty but amount was 10,000 rupees for each default, flat 10,000, here minimum 50,000, maximum 2 lakh. This is not important penalty, but first 3 penalties are important. 3 times of tax, IT return not filed 10 lakh, IT return filed but information not disclosed about asset and income outside India, then 10 lakh penalty. These 5 penalty. Now there was one proviso to section 42 and 43 for this failure to file IT return or failure to disclose information in the IT return. This penalty, these 2 penalty, both are mutually exclusive. There can be either section 42 or 43. For that there was a benefit or relaxation given, that in case if the asset outside India is bank account which is not disclosed, if it is only bank account and not disclosed, then no penalty will be levied under section 42 or 43, provided the maximum balance or the peak balance at any time during the given previous year, peak balance of that bank account does not exceed rupees 5 lakh in terms of Indian rupees. Penalty under 42 and 43 shall not apply in respect of an asset being one or more bank account having aggregate balance. Now here we are not talking about value of the bank account. Value of the bank account means total amount deposited till now in so many years. Here we are talking about bank balance. Balance at any time during the year does not exceed a value equivalent to rupees 5 lakhs. One or more bank account and the bank balance does not exceed 5 lakh rupees. Of course, here again you will have to convert. Bank balance would be in terms of foreign currency. You will have to convert from foreign currency to Indian currency and find out whether it is exceeding 5 lakhs or not for all 365 days. Here which rate to be applied? Here RBI rate not to be applied. Here it says explanation to section 42-43. It says apply telegraphic transfer buying rate of State Bank of India to find out whether bank balance is exceeding 5 lakhs or not. This proviso is now replaced from this current year, from 1st October 2024. The new proviso to 42 and 43 section reads as follows. Earlier this facility was available with a bank balance, maximum bank balance of 5 lakhs and only for bank account. Now the scope is expanded. There are many people found to be accidentally violating this provision, accidentally or unknowingly not disclosing in their IT return. I have got shares outside India. I am not disclosing the shares because I don't know where to disclose, but I am disclosing foreign dividend unknowingly. So I am disclosing dividend. My intentions are not bad. I don't have any wrong intention, but unknowingly I did not disclose the value of the shares. In that case, government says for small people benefit given. Section 42-43 penalty shall not apply if the asset is other than immovable property. That means including bank account, including shares, security, bullion, jewelry, everything, and the value does not exceed 20 lakh rupees. The aggregate value for all the assets other than immovable property. This is an important point. I am expecting question on this in the upcoming attempt. Keep it in your mind. 20 lakhs need to be remembered, and this facility is available for all assets other than immovable property. Okay. Now section 46 talks about the procedure of issuing show cause notice and all. It says for the purpose of penalty under this chapter, authority shall be required to issue show cause notice, giving opportunity of being heard to the assessee by asking him to show a cause as to why penalty shall not be levied against him. What is the time limit? Time limit to issue show cause notice. A penalty under section 41, the first penalty, 300% of tax, shall be issued at any time during the pendency of any proceeding under this act. When the proceeding is over, thereafter show cause notice cannot be issued. Show cause notice for penalty levy has to be issued during the course of pendency of proceeding. This is not an important point, ignore it. And for penalty under section 45, for failure to answer question or sign statement, minimum 50,000, maximum 2 lakh. Here, show cause notice has to be issued within maximum 3 years from the end of the financial year in which default is committed. This is really stupid. 3 years is too much. Today I fail to answer the question, you levy me penalty within reasonable time, levy me penalty within 1 week. You wake up after 3 years and tell me 3 years back you did not answer the question. Please tell us why we should not levy penalty. Prior approval concept is there depending on the amount of penalty. Just like Income Tax Act, this is unimportant. This is not from exam perspective. Prior approval of joint director or joint commissioner will be required in case penalty exceeds 1 lakh and the authority levying penalty is ITO level rank up to 1 lakh. Penalty is exceeding 5 lakh and the income tax authority levying penalty is rank of assistant commissioner, deputy commissioner. Totally unimportant, ignore it. Time limit to pass penalty order and the time limit to pass rectified penalty order. If any changes are to be made in the penalty order. So originally penalty order has to be passed within 1 year from the end of the financial year in which show cause notice is issued. Show cause notice has to be issued for section 41 during the course of proceeding. Section 45 lasts within 3 years from the end of financial year. For remaining sections there is no clarification. Therefore, for remaining sections, section 42 and 43 and even 44, penalty notice can be issued anytime. But once the notice is issued, tick 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 tick, meter is put down within 1 year from the end of that financial year in which notice was issued. AO will have to complete passing the penalty order. In case a penalty order is to be revised, it's to be changed, rectified, to give effect to, in case based on an order of Commissioner Appeals, Appellate Tribunal, High Court, Supreme Court or revisionary order under section 23-24, penalty order is required to be revised or revived, then such revival order shall be passed within 6 months from the end of the month in which order of higher authority was received by department. This is unimportant. Whenever order of higher authority is received, 6 months from the end of that month, the officer will have to pass the revived penalty order, rectified penalty order or revised penalty order. And while computing both these time limits, 1 year from the end of financial year in which show cause notice was issued or 6 months from the end of the month in which order copy of higher authority is received for passing revived order, the time of officer lost due to two things shall be excluded. giving an opportunity of being reheard to the assessee under section 7. This is exactly same as section 129 of the Income Tax Act, and the time lost due to stay order or injunction order of any court shall be excluded. After excluding these two time limits, if the balance time left is less than 60 days, then there is no concept of extending it to 60 days. Next is offences and prosecution. Chapter 5, totally unimportant, questions not expected, but quickly glancing through it. How many offences and prosecutions are there? 1, 2, 3, 4, 5, 6 and 7. 7 are there. These are same as what we discuss in penalty provisions. There were 5 types of penalties. So those 5 are reproduced here. First one is willful failure to furnish IT return. Failure to furnish IT return. Then rigorous imprisonment, 6 months to 7 years plus fine. Rigorous imprisonment. This is really dangerous. Okay, the government wants to take a very strict action. Or willful failure to furnish information in the IT return. So for this thing, section 49 is imprisonment. Same was section 42, penalty of 10 lakh. Section 50 of offences and prosecution is same as section 43 of penalty. 10 lakh rupee penalty for failure to disclose information in the IT return. Same way, rigorous imprisonment ranging between 6 months to 7 years plus fine. And under Income Tax Act, IT return is not filed by a person who is required to file. Section 276C, imprisonment ranging between 6 months to 7 years, or if the tax etc. is up to 25 lakh, then 3 months to 2 years. But there also is 6 months to 7 years, here also 6 months to 7 years. I don't know whether double will be there or not. 7 years here, 7 years there, 14 years imprisonment, God knows. Okay, but after all, it's a financial crime, so government always has a soft corner. Courts also have a soft corner. This guy is not a murderer. He is not dangerous for the society. Okay, so light moment. 51.1 and 51.2. Willful attempt to evade tax interest penalty by person whose ROR, or willful attempt, same thing, willful attempt to pay evade tax interest penalty by any person, resident, non-resident, anybody, whosoever was ROR at that time but today is non-resident, then 51.2, and today that person is ROR as on the date of catching it, then section 51.1. Both are same only. Rigorous imprisonment 3 years to 10 years plus fine. Rigorous imprisonment 3 months to 3 years plus fine. 3 years to 10 years in case he is ROR, or 3 months to 3 years in case he is non-resident. Lighter punishment for non-resident but unimportant. Then making false statement in verification or delivering false account. Rigorous imprisonment 6 months to 7 years. And 53, abatement. What is abatement? Abatement means encouraging others, helping others to make or deliver false statement, false account, false declaration, or committing an offence under 51.1, that is this. Rigorous imprisonment 6 months to 7 years plus fine. Last one, second and subsequent offence under section 49 to 53, 3 years to 10 years plus fine ranging between 5 lakhs to 1 crore. Caught second time, then 1 crore fine. Okay. Then section 54, slightly important, which is same as section 278E of offences and prosecution chapter under Income Tax Act. Presumption as to culpable mental state. Culpable mental state means guilty mind, intentionally done, deliberately done, meaning thereby anything which requires punishment or imprisonment only if assessee has done it willfully, intentionally. Out of them 4 places, the word willful is used. Willful failure to file IT return, willful failure to furnish information, willful attempt to evade tax interest penalty, willful attempt to evade tax interest penalty. Whenever it is done willfully, even in Income Tax Act also there were 4 provisions, here also there are 4 places where the word willful is used. Then what to do? Then whether it is done willfully or unintentionally, intentionally done or unintentionally done, by default court will presume that it was done intentionally. Prosecution of an offence requires existence of culpable mind on the part of the accused, then a court will presume the existence of culpable mental state. Court will presume that he has done it intentionally. However, accused may prove to the contrary, means assessee, the burden is on the assessee to prove that he is innocent, he has done it unknowingly. 55 section unimportant, taking approval or sanction of higher authority. Without sanction of higher authority, no person can be prosecuted, obviously. Offences by companies, stupid provision, very stupid language. Offences by companies, and then later on it says company means body corporate and includes unincorporated body like firm, AOP, BOI and Hindu undivided family. So company will include partnership firm, LLP, AOP, BOI, HUF. All unreal persons or all artificial persons will be called as company. So as far as company is concerned, if the offence is committed by company for which there is imprisonment also and there is a monetary fine also, the monetary fine will be paid by company, but who will go behind the bar? Imprisonment will be on the person who was the officer in charge of the company or person who is the managing director, partner, member of AOP, BOI. So officer in charge of the company as well as company, both would be deemed to be guilty of offence and both would be liable to be proceeded against and punishable. However, if such person, that is officer in charge, proves that offence was committed without his knowledge or that he had exercised all the due diligence to prevent the commission of offence, he would not be deemed to be guilty of offence. If officer in charge proves that he is innocent, whatever has happened without his knowledge, without his connivance, that is without his participation, he has not done it, he was kept outside the knowledge, other people have done it, and if he can prove that, then that officer in charge will not be liable to go to jail. Otherwise, he has to go to jail, he is responsible. And company includes HUF. On behalf of HUF, the principal officer will be Karta. Karta has to go behind the jail. Okay, then second point, which is same as what we studied in income tax, that offence is committed by company. Company includes so and so people and the punishment is imprisonment as well as fine both. Then fine will be on the company, imprisonment will be on the director, manager, secretary, other officer of the company. Same as section 278 E it should be E of the Income Tax Act. And as far as director is concerned, director means in case of partnership firm, partner of the firm. As far as company is concerned, company includes HUF, AOP, BOI, etc. Same way here, director, when we say officer in charge of the company is director, director has to go to jail, then director would mean for partnership firm, director would mean partner. AOP, BOI, any member of AOP, BOI, HUF, any adult member of HUF, company, the whole time director, and company not having whole time director, then any other director, manager, officer who is in charge of the affairs of the company. All these things are totally unimportant, questions don't come. Entire offences and prosecution you can skip as I have already marked, but in case you want to do it, I have revised it. Thank you very much. With that, this chapter Black Money Act revision comes to an end. See you in the next video with some other chapter. Till then, wish you a very good luck, all the best, study properly.